What's up, Outliers? Welcome back to the Outlier podcast. We have a familiar face, Mr. David Hunter. And we are, by the way, happy anniversary. Our first episode released on 6 December 2021. And in that episode,
really? Wow.
I know, when I was first prepping, I was just like, oh, we've been talking for, like maybe 2 years, 3 years, maybe something like that. And then I was looking at it, I was like, oh shit, like it's been a while.
Time does fly when you're having fun.
I guess. And I tell you what, the markets have provided no shortage of entertainment. So I actually thought it would be really, really cool to start first with your current analysis of the environment broad. And then there's some stuff that I want to ask about, like the evolution from when we first started communicating to where we are now, to see just how the landscape has moved in your mind and things like that. But figure the easiest spot to begin would be to level set and just get a sense of what you think about where we're at now, what markets stick out to you, commodities, anything, really anything that is top of mind for you. I'd love to start there to understand the landscape.
Okay. I know we talked a few months ago. I can't remember exactly when it was. So my fourth quarter letter came out in early October.
We spoke right around 23 October. Sorry to cut you off. I just pulled it up right now so that I could give it to you.
Good. Yeah. So you already know this, I think, because my letter had been out, but I raised targets back there for the S&P and the NASDAQ, the Dow, and the Russell. So my current targets are the same. They were 9,500 for the S&P, 65,000 for the Dow, 32,000 for the NASDAQ, and the Russell I raised to 3,800 back then. So, basically 40 to 50% upside from here. A little less than that for the Dow and the S&P, but I'm fully on board with that forecast, very comfortable with that forecast. Think we're going to see a lot of it in the first quarter and probably spill over into the second quarter. I think it is a first half event, as has been my nature. I'm always extending things because the market decides when it's going to top out. But at least right now, that looks like a pretty good forecast. I think in the very short term, you could see a 3, 4, 5% pullback in the market. It's rolled over the last couple of days. There's any number of things out there, including Iran, that could trigger a quick sell-off. So I just see, when I look at the charts and things, some potential. It doesn't have to do it, but some potential. So you might take the S&P down to, I'm just looking at numbers I looked at this morning, maybe down towards 6,700. And I'm not sure, NASDAQ might be a little more percentage wise, but basically it'd be just to pause it, refreshes, a quick reaction to some things. You got tariff things, if the courts rule on that could trigger a sell-off. Or we're in the middle of earnings season, just beginning earnings season, so it's something there could do it. It's not any kind of a reversal. It's just a quick kind of, it's gotten a little overbought, and it wouldn't surprise me if this little rollover we've seen the last 2 days extends for another few days. But I'm hugely bullish. I think the bull market will be driven by lower rates. I keep saying the bond market, I think, is poised for a big move in 2026. I am also, obviously, can't ignore what's going on in the metals. I mean, we are seeing moves there, particularly in silver, like we never have seen before. In my October letter, I raised my silver target from 75 to 100. In my most recent letter that came out last week, first quarter letter, I raised it again to 125. So I'm looking for, still a lot more upside here. And as I said in my letter, because we're in a parabolic, that 125 could just easily be 135 or 45. It's when you get into that vertical, there's no magic to what point it stops. It's going to burn out quickly at some point. But I think there's still plenty of upside ahead. The institutions still aren't on board with the silver or gold, really. Gold more than silver, but silver, I think, probably has the more upside here. I raised my target on gold to 5,500 from 40. I guess it was 5,000. Yeah, I had raised it in October to 5,000 and just raised it again to 5,500. So, and the other one, copper, which I have maintained a $7 number since early last year. When they announced tariffs in April or soon thereafter, some tariffs on refined copper, it dropped down. It had touched $6, dropped down to like 4 or 4.25, and it's back up over 6. I just raised my target on copper to $8. So, metals of all kinds, I think, are rolling here. The materials ETF is breaking out and looks like it's got lots of upside ahead. And we're seeing a broadening in the market right now. The Mag 7 is taking a rest right now. The semis, at least in the last couple of days, are taking a bit of a breather. But ultimately, I think it's going to be everything moves. It's going to be across the board. Most of the market is going to be the small caps, the large caps. We should have a pretty good next 3 to 6 months.
I have, what is this, 9 follow-up questions from that.
I went through a lot.
Yep, I have 9. But before the 9, I want to walk you through some of our prior videos. I'm just looking at my YouTube channel, and I'm looking at some of like the general titles that I use to kind of figure out like what's going on in there. And in 22, we had talked about the potential for a bust. In 22 in March, similar. And then in July, we started talking a little bit more about the melt up. Then on 24 October of 22, we talked about the market bottoming and starting to move up towards highs / melt up scenario. And then specifically, I noticed I'm skipping a couple, but when I got to 1 December of 23, we had talked about the melt up effectively being underway. And then on 17 April of 24, we were saying that the melt up is effectively going on. And then I see the same on 18 October of 24. And as I just listened to what you were talking about here, it sounds still supremely bullish, very, very upside oriented. One of the things I was curious about is when we look at the timeline, you had obviously anticipated upside. I'm curious how the upside has like rolled out against your expectations, because I know that you had spoken a lot about velocity, but based on our conversations, to me, it seems like it's been like this pretty steady, pretty aggressive move up that's continued for some time. And I'm wondering how that factors into like what you expected to see.
Well, certainly I never expected it to take this long or last this long. I attribute a lot of that to 2 things. One, keep in mind when we look at the Fed balance sheet in 2008, it was 875 billion. That was the largest it had ever been from 1913. Fast forward through the 2008-9 downturn and the response to that in QE1 and 2 and 3, and you're up to 3.7, I think 3.7 trillion. And then the pandemic hit, and we went from 3.7 to 9 trillion. So we have never seen, and that happened over the course of 12 to 18 months, where they panicked, they closed the entire world economy down for a quarter, and they said we got to do something to offset that. So they panicked and printed money like crazy. So you had 5 trillion go into the market or into the system, and that's just Fed money. Well, obviously other central banks did similar. So we've never had 5 trillion. We never had 5 trillion as a balance sheet. Never mind 5 trillion put into the system in a year and a half. And so you never know. Yeah, I mean, it's unprecedented. It's nothing we can go back and look at past history. You never know how much of that money, how long it's going to take for that money to kind of flow through the system and be used up. We're still going. I mean, that 5 trillion is still part of why we're still going. So from that side, I would argue we're just in uncharted territory in terms of Fed liquidity and liquidity in general that's kept this thing afloat. From a technical perspective, what we've had, which is amazing to see, is that I'll really start from 22, from the bottom in October 22. Keep in mind, people were expecting at that time the market bottomed at 3,500 or thereabouts, and the majority of calls at that time were saying we're almost decidedly heading for 3,200, maybe below 3,000, and they were bearish. We moved up. When they saw the thing come out of the 3,500 and move up, the most of the street was, yeah, okay, you can get a bounce. It was oversold. It can go a few hundred points, but it's going to roll over. And all the way up from 3,400, 3,500 to 3,800, 4,000, 4,200. That's all you heard was it's a bear market rally. Yeah, it's extended more than I expect, but it's rolling over. And so they stayed skeptical. When it got above, and I can't remember exactly, but I think above 4,300, certainly above 4,500, uh, people started getting more on the bandwagon, saying, well, this has a little more legs. But 4,800 is the high that we came off of back at the end of 21. So we're not going above that. That's a double top. And then when it blew through that, all of a sudden they had to acknowledge that, hey, this is no longer a bear market rally. This is something more than that. But even then, all the way up through to today, every little sell-off, people, as I keep saying, institutions particularly, have one foot out the door. They're kind of halfway there saying, I got to stay invested. But every little sell-off, they get bearish. And then we get a little more than a little sell-off like last April, and you had sentiment go back almost to the 2020 lows. So what that all is that you've had a wall of worry. It comes down as you rally, but it gets rebuilt very easily with a 3, 4, 5% sell-off. And if you get something bigger than that, 10 or 15%, it really gets rebuilt. That allows this thing to have continual fuel. So from both a monetary standpoint and from a technical standpoint, this thing has just been, I think, uniquely positioned to keep extending. And what I have done, and because as you well know, I get beat up on, not so much lately, but beat up on X for calling for a bust, and having called for a bust for years. I go, but if you look at what I've said all along, never once have you seen me, even in 22 when we were selling off, but never once have you seen me say the top is in, or that we're near the top. What I've said consistently is a global bust will follow the top. And I've continually raised targets and extended the bull market without any hesitation or without any lessened conviction. What's misunderstood is that there's no timing to that. I get myself in trouble, certainly, when people ask me, well, when do you think the bus is going to hit, or well, when do you think the top's coming? And, many times in the past, I've said, well, maybe, we might have another 6 months to go. And then when we get there, next thing you know, it's another year past that, and it's another year past that. So if I were a timer, I'd get Fs, if this were based on timing. But if you listen to my calls, it's not based on timing. Is based on when do we reach my targets.
It's funny you frame it that way, because when I was looking through the videos, it's kind of what I picked up, is that, like, if somebody were to ask me, like, how is the timing played out on your calls, I definitely would say it hasn't lined up objectively. But in terms of milestones, as I look at this, it's kind of crazy, to be honest. Like, how some of this stuff lines up. Because when I was looking at our 24 October 22 video, you were literally, the title of that video was Market Bottomed and Headed for Top. Now, the rest of that is in 6 months. So obviously the 6 months didn't come to fruition. But if we think of what you're talking about in general, 6,000 across that, then I look at 1 December 23, and you had a target, I think at that point, or in the thumbnail, I have 7,000. So that obviously was on the plan. So it's really interesting to see like the major muscle movements as you're thinking of them, and then experiencing how complex of a system markets are. When you think about the way that you forecast and the way that people should interpret your forecasts, there's kind of two pieces to it, as I typically see from our conversations. The first piece, well, I guess three pieces. There's typically a target, some sort of velocity measure, right, in terms of what the shape might look like. And then there typically is a timeline associated with it. So when somebody is like listening to what you're talking about, and when somebody is digesting, across those three vectors, unless there's more that I'm missing from your lens, but of course, those three vectors that I see in terms of target, velocity, time frame, how do you think they should like prioritize those pieces as they're listening to you and digesting the information?
Yeah, so the timing typically is to give a best guesstimate at that point in time of how this might play out. So and people laugh at me because I probably use the term 3 to 6 months as a constant rollover, but it's really not, as I say, I'm not providing a trading call, which trading call, obviously you're a trader, really does have to have a time element
Very
to it,
timing
right?
specific. Yep.
But as a strategist, I'm calling a cycle. The cycle is going to be determined by the market, not me. I mean, that may sound like a cop out, but that's really true. It's I don't control the market when but I do control what I see ahead of me. And so as long as I'm continually seeing more upside, um, I'm not so worried about when does this come to an end. If I'd said, I think we're 100 points away from the top, and you're not going to be able to time it quickly, get out, or you're not going to be able to get it perfectly, get out, then I'd be guilty of making a bad call. But if typically when I'm raising targets, I'm raising them when everybody else is going the other way. For example, last April, when the market dropped 20% and people said the top is in, and they started lowering their targets, I raised mine. I was at 8,000 and raised to 8,700, right near, within 50 points of the bottom in April, and then raised it again in October to 9,500. So um, I'm raising way in advance. I'm not playing a good till reached game. I'm not saying, okay, momentum has taken me almost to my target. I got to raise it, or else, I'm going to have to turn bearish. It's not that. I'm usually going by sentiment. If sentiment's getting more favorable, meaning more bearish, and giving me more fuel for the upside, I may see that there's more room. And obviously, I'm looking at things from I may be looking at 20-year charts or 10-year charts or 5-year charts. And so there's a much broader perspective of what's the upside. What I can't tell in using that broader perspective sometimes is how fast it'll happen. The reason I've constantly said it could happen pretty quick is that at some point here, and I think we're getting close to that point, but I thought that before.
Three to
Um,
6 months.
we're going to go, yeah, we're going to go parabolic. And once you go parabolic, I mean, just take a look at silver. If you
Right.
want to understand my thought process going all the way back to the teens, back before 2020, where I saw that ultimately we were in a final, last several years of a secular bull market that started in 1982. It would steepen until it ultimately, and at the end, went vertical. Just look at silver in the last few months, and you'll have your description of parabolic. I mean, and That's what I'm saying. Silver went from, I don't know exactly when this was, but from 30 to, you know, now 90, triple in a year's time, or less. So so it may sound crazy to say we're going to cover 40 or 50% of the market in 3 to 6 months time, but that's what a parabolic takes you, can give you. And so that was always why I said, well, it could come as soon as 6 months from now. I never said 6 months from now. I said it could come as soon as, but what gets interpreted is they hear the 6 months. So they say, well, you said it was going to top out in 6 months. No, I said if all things fell into place, it could be as soon as that.
Well,
And that's the reason I would use that, is because of that parabolic final part of it, and that I thought we were getting closer to that.
which, funny enough, if anybody, when you have time, pull up a chart of SPX and just go back to, like 1990 to present and throw like a standard deviation channel on it for context. And you'll see right now to the upside, we're like 4 standard deviations to the upside. So depending on, the nature of parabolic and, the duration and time frame of it, one, I think, could easily argue that we're starting that, or at least in it, because effectively, from what I see on the lows in 22, 23, kind of that after that bear market, it has been a absolutely profound move up. We did have that pullback in April recently that immediately got undone. So
Yep.
yeah,
That's
please.
it's amazing that we had that, whatever it was, 50% move, maybe more than that. Let's see, S&P was down around 48.40, I think, and moved up to, well, now we're 7, but in October we were probably 66, 700. So it was basically a 50% move, happened in 6 months time. And I have people pushing back at me when I'm saying melt up, and saying this is melt up means an unusually strong market. And they're trying to argue that it's a very normal market. And I go, it's not. If you go back and look at this last 5 years, this is not a normal market. And, yes, you had some big volatility in early 2020, and some volatility in 2022, and a little in 23, and again in April. But those are just corrections in the bull market. But if you look at the amount of ground we've covered, I think the Nasdaq was 10,100 in October of 2022. We're more than double there in a few years. I mean, the S&P was 3,500. We're double that. And yet you have people complaining that it's just a normal market. You're talking about a melt up. This doesn't look like a melt up. And I go, yes, it is. Stretch out like you did, stretch out that chart, and you'll see a much. What my whole thesis is that every leg is going to be steeper than the last one as we move into the top.
Which is really, really interesting, because one of the early questions I had for you that I definitely admittedly still struggle with understanding is trying to understand like the continued fuel, right? When I look at the recent few years, I'm already seeing from what is this, from the recovery of 2020 towards the beginning, like 2021, S&P was like 3,400. So from that point to now, we've doubled. And I sit there and I say, like, well, there's a lot of new technology that came out over this time frame. There's a lot of stimulation to the economies and whatnot. So like I can see specific things that can fuel this. But then to like picture something that goes even more parabolic, in my mind, I think, like, what are the additional catalysts that could drive that kind of move, given what we've seen so far and what that's led to? When you think about when things might go like really parabolic in a short-term time frame, what's the fuel for that?
I think a big part of the fuel is going to be, we've been in a 2-year basing process for the bond market. Everybody wants to be bearish bonds, or at least, long bond. They're talking about it going up, rates going up, not down. And people are discouraged because the 10-year, is stuck in this trading range between 4 and 4.20. Um, I think we are poised for a move down to 3% and below in the next 6 months. So by mid-year, um, probably 3% and maybe below 3%. That's a big move to go from 4.15 or wherever we are today down to 3%. So one is rates down, and I don't care what the Fed does. Everybody wants to focus on the Fed. The bond market's, I think, ready to rally either way. Um, the dollar, as you know, I have a target of 82 on that. I think it's very close to the end of a 6 month consolidation. Maybe it's longer than that even. Um, and we'll roll over and head for 90 and then probably consolidate again before it heads for 82. Big drop in the dollar will help, I think help. Um, I also think you have an underestimation of just how much is going on in the Trump, not you, but the street, just how much is going on in the Trump agenda. You've got deregulation, you've got the big beautiful bill. There's a lot of things that don't kick in until now. So I think there's a lot of things like that that will be received by certainly the institutions as they see it starting to happen. They're going to become more bullish on that. I think the narrative that you will get over the course of the next 6 months is going to be moving more and more towards um, either a soft landing or not even a soft landing. That this thing gaining some legs. That the Fed's just beginning a new easing cycle. Not so much from a rate standpoint, but from a monetary standpoint. They pulled the balance sheet down from 9 trillion to 6.5 trillion, and they're now having to pump money in again because the banking system's needing it. So you're starting to pump money again. I think you're going to see as we move towards the second quarter, the rhetoric is going to be, the narrative is going to be, this thing has legs. The Fed's just beginning. This thing can carry for a couple more years. Um, Interest rates are coming down, so the multiples can expand even further. Earnings, which have been remarkably good through all of this, may accelerate or at least stay just as good. So I think, and then you've got deregulation, which deregulation is going to help energy. Not that that's one of my favorite areas, it's not, but deregulation is going to, I think, help push oil down, oil prices down, and that means lower inflation. I think um, the deregulation is definitely going to help banking. Not the stocks notwithstanding the last 2 days, but I do think you're going to have more and more of those things that people can latch onto, particularly if you have a positive tape. Institutions are finally, I think, going to be all in. And they have, as I said before, they have fought this thing all the way up, even now.
We're talking about their financials. What do you make of the 10% cap that Trump was talking about placing on credit cards? Obviously, near term financials pulling back a bit. What do you think of the longer term impact there?
Yeah, I'd have a hard time seeing that we're going to get that. I mean, I, I think it's typical Trump starting with some extreme position and then working back towards something more amenable to everybody. I do think, and I know the bank analysts will push back and say, they need those rates because the lower end of the income scale, there's a lot of defaults, and if you want lower income people to be able to have credit cards, they've got to accept that there's more write-offs there for the banks. They've got to be able to write this profitably, et cetera. I think rates are usurious once you get up, certainly over 25%, maybe over 20%. So I could see it going back more towards the high teens or 20. And keep in mind, he's only saying for a year. So that's basically, what is that? That's an election year promise, or an election year delivery. So I could see maybe we get something like that, and I think the banks can operate in that environment. Um, I think it's amazing. I think the analysts carry water for the banks, or and talk about how it's devastating if you cut their rates, your credit card rates. But I mean, come on. And so I do think at the high end they're too high. I think 10% is not realistic. This is an unsecured credit, so they have to be able to write it at a reasonable rate. But I think somewhere between 18 and 20%, I think, could be an area. I don't know if they're going to ever get there. Whether that, but I don't even think. Again, that's how Trump starts his negotiations, is at some extreme place. And he's pretty convincing that that's what he thinks it needs to be. But he's got, in my opinion, probably the best Treasury Secretary we've ever had working with him, and I don't think Scott Bessent thinks that's reasonable at 10%. I would guess that this thing will get negotiated higher, but we could see it, see some kind of a cap.
It's funny you say that. Honestly, I was talking with my community about that not that long ago, and the first thing that I said is Trump negotiation tactic. That's the first thing I thought too. Next one. This one I find is funny. By the way, we just got through my first follow-up, so we're crushing it.
Oh, this is going to be a long video.
My next follow-up. Tariffs are announced. Market loses its mind and craters. Right? We'll put it in context. Not really that bad, but does go down. We're talking about potentially the court saying you can't do tariffs. And now we're talking about the market going down on the reversal of the news that it went down to before.
Right.
Why? Why is that the case?
Yeah, well, first of all, everything you hear is that even if the courts rule against the administration, they have plan B, plan C, plan D. And so I think any reaction to the tariffs will be days, not weeks. Could be the reason for a 5% sell-off. I don't think it's anything more than that, and it may not even be that. And I get your question, which is, how can it be bad to introduce tariffs and then be bad to rule them out? I the street wants to worry about everything, I guess. So and funny, I don't know whether it's a clue or not, but the fact that they keep pushing back their decision, I don't know whether the Supreme Court is nervous about it or what's going on there. But frankly, I trust Trump has some good people in that area. Jameson's a good guy, and I think his economic people are pretty strong, and his legal people too. I just don't think you're going to see tariffs just wiped off the map here, no matter what the Supreme Court rules.
Yeah. Yeah. With respect to crude oil, we have had obviously the party in Venezuela, which I have to be honest, from a military lens, that shit was awesome. From every other lens, you're free to have your opinion. The fact that went down the way it did, though, from a militaristic perspective, super impressive. But now we also have the conversation with Iran entering the picture. We might get Greenland somehow, some way. Shane Gillis, I don't know, he's a comedian. I'm not sure if you're familiar with him, but he has a hilarious joke about that. He says he really hopes that there could be the potential that the trick from Leif Erikson 1,000 years ago about Greenland being green and Iceland being ice, but it's really switched. His joke is that he wonders if that's actually playing out here. Obviously, it's a little bit more than that, but funny joke nonetheless. But there's a lot going on in different kinds of commodity-based sphere, and I want to focus on oil for just a second. What's your perception of oil and what the future, whatever time frame you think of, looks like for oil? Because there's kind of a few competing factors going on right now.
Yeah, for sure. I mean, obviously, it's bumped up from the mid 50s to 62 today, I think. And I put out recently that when people ask me, "What do you think oil's going to do before the bust?" and I said, I still don't think it's one of the lead sectors. I think it'll stay in a trading range, probably low to mid 50s to low to mid 60s. And I said the low to mid 60s is probably if you see any kind of geopolitical stuff, rear their ugly head. That's why you would get up there, and that's what we're seeing today in the last couple of days. Is the Rand news is, I think, this certainly sounds like something could be imminent in terms of Iran. So, people get nervous about it there. Could it run to 70 real quick and something like that? It could. I mean, geopolitical moves, who knows, in the very short term. But I think ultimately it would settle back down. Supply and demand forces would tell you that it's, unless it's a drawn out thing, and I don't expect that at all, supply and demand would tell you that it belongs in the 50s. Um, and then I think in a bust with an economy tanking around the world, it belongs in the 30s and maybe below that. So that's kind of my outlook. Um, and what I will say, and with respect to Venezuela, you hear a lot of people want to poo-poo the 300 billion barrels of oil, or is it billion or trillion? I don't know what it is there that Venezuela controls. Their reserve, under their control. And people say, well, it will be, that's a 20-year plus type program. It's not going to influence anything. My forecast, as you know, is $500 oil by the early 2030s. And that means we come out of the bust with oil down in the, at 30 or below, and we start building up from there in the first year or two out of the bust. You might be, 50, 60, 70. And then by the time you get to the end of the decade, you might be 200 or 150. By the time you get into, say, 2032, 3, you're at $500 a barrel. If you get oil moving like that, and you're getting it because of the massive money that will be printed to get us out of the bust, if you get oil at those levels, you're going to see all kinds of development, and having Venezuela available to develop rather than be under a regime that was basically taking the oil the other way, meaning Maduro. If you have a free market system down there, if you have a democratic Venezuela, that country, number one, is going to be like the Middle East was for so many years, rolling in money. Their citizens are going to say, "Wow, thank you, Donald Trump." But number two, from a world perspective, that really is a huge thing to have. You know, if you remember back 25, 30 years ago, peak oil, I think it was 20 years ago, whenever it was, peak oil, meaning we're running out of oil in the world. There's nowhere we're going to be able to develop oil to meet the demand. Obviously, that's not true. If you've got, Venezuela is one place to tap. So I don't buy into all the negativity saying, what's Trump doing? That oil's not going to be developed for decades anyway. He talks like that's something that's really going to help the world economy and help the U.S. I do think it will look like a masterstroke when they look back at it. And it does feed into my view that, oil will be one of the lead groups to own post bust. I don't want to own it now, but post bust, energy is going to be right at the top of the pack, I think.
And for those that don't remember, Venezuela, when they first started discovering their oil, Venezuela was insanely profitable as a country. They were insanely profitable. And
Yep.
yeah, it obviously started turning the other direction. I think they have like 500 billion barrels of recoverable. I think their current reserves are like 300 billion or something like that,
Yep.
303
Yep.
or something close there.
Yep. And they've been producing less than 1 million barrels a day, I
Yeah.
think, where they had been producing 3 million before they, you know, kind of got wrecked.
Yep. Two more follow-ups. The first one, we talked about it a little bit earlier, but it's absolutely fascinating. The move in gold. Who who is buying gold right now, and what's the play?
Well, certainly the central banks are buying it. Certainly China's buying it. Certainly the BRICS are buying it. I think other countries are. I think maybe some of the Eastern Europe have begun accumulating gold. Um, and certainly institutions have to be starting to accumulate gold. I mean, the gold story has been around for a couple of years now. Silver's later, but certainly gold, I think, has been a few years here. And so the institutions have had time to kind of move away from the idea that, well, gold, the Warren Buffett idea that gold doesn't pay you anything. There's no dividend, there's no earnings or anything. So, he was never a fan of gold, but gold is a monetary asset. And certainly there's a lot of reasons why it's moving up. But right now, demand far outstrips supply, and prices are going to continue to go up.
And do you think that the folks that are accumulating gold, is this some sort of like decade long play? Is this a shorter term play that they just want to add it to the balance sheet? Like what's the driver for gold now? And what do you think the game plan is for the position?
Yeah, certainly for the central banks and certainly for the BRICS, they think if they can accumulate gold and move to some sort of a gold-backed currency, that they can compete with the dollar. And I think that's their long-term plan. And it's that plus the fact that I think for all central banks in all countries, everybody kind of could step back and say, you know, the world we live in today is uncertain. The fiat currency environment is uncertain. We want some gold as a hedge or a protection against what it looks like, which is to get out of this massive debt of 330 trillion around the world. There's only one way you're going to get out of that, and that's to print more money, right? And you're not going to get out of it, but the only hope you have is to print more money. So it seems naturally that you would want something that moves up with inflation, moves up with, liquidity. And I think that's a lot of what's behind gold kind of from afar. Near term, it's more the central banks are buying it and there's not enough gold around.
Got it. Last question, pivoting to sentiment. You've referenced it earlier that that's like a primary driver of how you conduct your analysis. When you think about the bust, what are some of your preferred sentiment gauges, and what do you think they might look like? Maybe not like at the bottom of the bust, but leading into the bust. The implicit concept here is to try and give listeners some sort of idea on what they can look at to monitor for like the topping function as you see it before we start rolling over.
Yeah, I never use the sentiment indicators in any kind of scientific way where I have numbers that you know, but it's pretty easy to see. I mean, you can use as simple as one as the CNN fear greed index, because you can see it's got the dial, and obviously you want to get it way over to the fear side to be bullish, and way over, when you see it way over on the greed side, you want to be nervous about the markets or be, cautious. Um, but, AAII is one, obviously, you can look at the CNN fear greed index, whatever they call it. Um, the one that I like is the Bank of America has a survey of portfolio managers or fund managers, and it's kind of gives you where they are in terms of accumulating cash or allocating to equities, et cetera. And that usually tells me where the institutions are at to some extent. Um, there's a investors intelligence, which is a measure of some of the guys like me, letter writers out there, and that gives you kind of a sell side perspective on what the strategists think. Um, so you can get perspective from money managers, from strategists, or people that have opinion on the market, from individuals, and just put it all together. And I just it's pretty easy to read sentiment as long as you're looking at it from extremes. When you're in the middle, you kind of have to have a feel for it. But when you're at those extremes, it tells you something. And I think we will see at the top, there will be an all-in type sentiment. Like I said, people think this thing has legs and can run for a couple of years. And when you're at the bottom, nobody's going to want anything to do with it. And
Right.
we saw that in 2020, in March 2020. And the thing, I use sentiment more. Like I said, I don't. It's not so much a numbers thing, but there's some feel from the when everybody's talking very negative. When you hear that there's you know you don't have any use for that, whether it be a stock or whether it be a metal, whether it be like, well, silver a few years ago, people had no use for silver, and as you well know, I was getting beat up for being a bull on silver. People were sure it was not going to get out of its own way because every time it lifted its head, it went the other way or it sell off again. And when you see that kind of sentiment, that's that should warm the cockles of your heart. You should start thinking, hey, this thing might be attractive.
Last question. Looking out to the year ahead, what is most interesting to you? Like, what do you have your eye on going through? Maybe not even the full year. That's kind of a long time, but let's say like the next quarter.
Yeah, well, I think it's a very interesting exercise here with silver. Silver, should be front and center for everybody because it's moved so quickly from 50 to 90. Um, and you've got people, I I had 75 as a target for several years, and I was way above almost anybody. There were people that thought we might double top at 48, but then there were lots of people that thought it couldn't get above 35. Um, and when it blew through 48 and 50, it was at 75 very quickly, and then kept going. It's paused for a little while, and next thing you know, you're at 80 and 90. There's one guy anyway, and maybe a couple guys out there talking 200 and 300. Now, I don't know if they really think you can get there in my time horizon because I have a $500 target on silver. It's just not now. It's early 2030s. Um, but I think this guy, and one in particular, is talking about more this year. And like I said, if you go into a parabolic, there's no, I can't argue that that can't happen, that we can go to 200. I would have a hard time thinking that's what we'll do, but it's not impossible. And that's a big statement to say that you know, a, an industrial metal, an important metal, a metal that's, certainly watched by a lot of people, could go from being $30 less than a year ago to something, seven times that number. That seems pretty incredible. So I'm gonna be watching that like anybody else. I have 125 as a number, and that's pretty exciting. But I don't know what the next few months brings. It could just blow through that. And then um,
Sorry,
I,
just a super quick note on silver for folks, just to give them a little bit of context. I'm measuring it right now. And when it started its breakout on the 28th of November of last year, so 32 trading days ago till the close right now, it's up 73.8%, 32 trading days. So just to give context to what you're talking about.
yep. And you keep hearing that there's a shortage of physical, that the paper dwarfs, and that there's a lot of shorts on the paper, particularly in the European banks. So who knows what happens there? I mean, so I'm watching that almost more out of fascination to see what really does come of that. I'm comfortable with my forecast, but I also know it could blow right through that.
Sure.
Um, and and then I just think, the equity market, this is history. I mean, I really do believe we're at the end of a 43-year secular bull market, whether it tops, in April or tops in June, or again, I have to extend. I don't think so, but it could. Any way you slice it, I think we're very close to a top relative to the fact that it started in 1982. And again, there's another thing. The Dow, the Dow is what, 49,000? Um, and that started this move back in 1982 because I followed the Dow more than the S&P back then, so it's etched in my mind. I think it was 780 at the bottom in 1982. So it's gone from 780 to 50,000. I mean, this is one hell of a bull market. Again,
Yeah.
it's a secular bull market. There've been cyclical bears within that, but so just the fact that this thing could go parabolic, that the equity market could go parabolic, I think that's going to be really interesting to watch in the next, 3 to 6 months too.
Well, I cannot wait. And as always, it's absolutely awesome catching up, David. Thanks for taking the time to hang out. I know folks can find you on X. They can reach out to you for your newsletter there. I will have the correct links to all those so that they can find the correct person there. But as always, really, really cool. Just poking around, understanding how you're viewing things. And I appreciate you taking the time to share with us. And I'm looking forward to catching up in a few months and we'll see how it all lays out as per usual.
Yeah, thanks for having me on. I will say these 3 months that we have between go awfully fast these days. It feels like we just talked.
Yeah, it's always good to catch up, David. Thanks for hanging out.
Okay, thanks, Eric.
All right, see ya.